The term structure of interest rates is a fundamental concept in fixed income analysis and describes the relationship between interest rates and maturities. Spot rates, also known as zero coupon rates, represent yields on securities that make a single payment at maturity. These rates form the spot rate curve, which serves as the foundation for valuing bonds and deriving forward rates. Forward rates represent future interest rates implied by today's spot rates and are calculated using no arbitrage principles. Understanding the interaction between spot and forward rates allows analysts to value fixed income securities accurately, estimate expected returns, and interpret the information embedded in a yield curve. Spot rates are critical because they provide the correct discount rates for individual cash flows. Unlike yield to maturity, YTM, which applies a single discount rate to all bond cash flows, spot rates recognize that each cash flow may require a different discount factor depending on its maturity. For coupon bonds, YTM is effectively a weighted average of multiple spot rates rather than a direct market rate. Consequently, bond pricing based on spot rates is generally more precise. Analysts frequently use spot rates to value bonds, compare securities, and construct benchmark yield curves that reflect prevailing market expectations regarding future interest rates and economic conditions. The spot rate curve can be derived from the par curve through a process known as bootstrapping. The par curve consists of yields on bonds trading at par value across various maturities. Bootstrapping begins with the shortest maturity, where the spot rate equals the par rate, and then sequentially solves for longer-term spot rates using previously determined rates. This methodology ensures consistency across all maturities and generates a complete zero-coupon yield curve. The resulting spot curve provides the basis for valuing fixed income instruments and calculating forward rates. In practice, bootstrapping is widely used by financial institutions to construct reliable benchmark curves for pricing and risk management. Forward rates are future interest rates implied by the current spot curve and are derived using arbitrage-free relationships. A forward rate reflects the rate that makes investors indifferent between investing for a long period today or investing for a shorter period and then reinvesting later. The forward rate model links spot rates and future rates mathematically, ensuring no arbitrage opportunities exist. Forward rates play a central role in fixed income valuation, derivatives pricing, and interest rate forecasting. The collection of forward rates across maturities forms the forward curve, which can be derived directly from the spot curve and reflects market expectations embedded in current bond prices. The relationship between spot and forward curves provides important insights into market expectations. When the spot curve is upward sloping, forward rates generally exceed spot rates, resulting in a forward curve positioned above the spot curve. Conversely, when the spot curve slopes downward, forward rates are typically lower than spot rates. If future spot rates evolve exactly as implied by the current forward curve, investors will earn returns consistent with market expectations. Deviations between realized future spot rates and implied forward rates create opportunities for active portfolio managers to generate excess returns by anticipating interest rate movements more accurately than the market consensus. A practical application of forward rate analysis is the strategy known as rolling down or riding the yield curve. This strategy involves purchasing bonds with maturities longer than the investor's investment horizon. When the yield curve remains upward sloping and unchanged, the bond's yield declines as it approaches maturity, causing its price to rise. Investors therefore benefit from both coupon income and capital appreciation. The strategy can enhance portfolio returns compared with simple maturity matching. However, success depends on stable interest rate conditions, and unexpected increases in rates may offset the anticipated gains, making yield curve forecasts an important component of portfolio management. The swap rate curve is another major benchmark curve used in fixed income markets. A swap rate is the fixed interest rate exchanged for a floating market reference rate in an interest rate swap. The swap rate curve is constructed from swap rates across multiple maturities and reflects the credit quality of large commercial banks rather than sovereign governments. Because swap markets are global and less influenced by country-specific government borrowing conditions, swap rates are often more comparable across countries. Financial institutions frequently use the swap curve to value assets, liabilities, and derivatives, making it one of the most widely referenced yield curves in modern finance. The construction of the swap rate curve relies on market reference rate spot rates and the determination of fixed rates that equate the value of fixed and floating swap payments. The resulting curve serves as a benchmark for pricing and risk analysis throughout financial markets. Analysts compare swap rates with government bond yields to calculate swap spreads, which provide information about credit and liquidity conditions. Since governments generally possess lower credit risk than banks, swap rates usually exceed comparable government yields. Consequently, the swap rate curve not only supports valuation and hedging decisions but also offers valuable insights into market perceptions of banking sector risk and overall financial conditions.